Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving right into. The S&P 500 snapping a 4-day losing streak thanks to the CPI reading. We've got a check on the market action, including moves in the AI trade and gold. Plus, a look at the future of Berkshire Hathaway without Warren Buffett at the helm. As the leadership transition takes place, we speak to one shareholder and get the bull and bear case on the company. And we've got to look at one of the worst performers of the Dow Industrials this year. That would be Salesforce. What's weighed on the stock and how it can turn around, that's ahead. Well, Berkshire Hathaway has long been seen as the ultimate buy and hold stock, but now investors are asking what the next chapter looks like without Warren Buffett at the helm. We're laying out the bull and bear case for Berkshire in 2026. And joining me now, I've got Mel Casey, Senior Portfolio Manager at FBB Capital Partners. Mel, it is good to see you. So let's have a bull-bear debate here on Berkshire, Mel. And just full disclosure, you are a shareholder. We'll start with the bull case, though, because you say here, Mel, this is interesting. You say Berkshire has an all-weather quality, is how you put it. What do you mean by that, Mel? Explain that.
Well, thank you for having me on, Josh. I think if you look at the at Berkshire Hathaway, it's primarily an insurance business, but really it's large enough that it's a conglomerate. It's involved in many different places. So there's kind of a cyclicality and a counter-cyclicality within that portfolio. So you could almost even think of it as an alternative to a lower risk alternative to owning the broader market. And you're going to find some of the businesses like the insurance are counter-cyclical, but then other parts like the railroad are going to be more sensitive to the economy.
How would you characterize valuation here, Mel?
So in a year of pretty high valuations for U.S. large cap stocks, I think Berkshire's still pretty reasonably valued. If you look at the estimates for next year, it looks a little closer to the overall market on a price to earnings ratio. They prefer book value. I think that's fair because there's so many different businesses here. On book value, it's around about 1.5 times. That's historically a little bit higher than it had been before. Also, shareholders who pay attention know that Warren Buffett advocates repurchasing stock at 1.2. So it's a little bit above his level. But when you look at some of the other companies that make up the market, it's certainly reasonable, if a little bit higher than it has been in recent past.
And Mel, post Buffett, how does the bench look at Berkshire? Would you say that falls into the bullish column?
Cautiously bullish. We've had a couple of changes in that bench recently. That was a little surprising, I think, to investors. Todd Combs' departure in particular, been there a couple of decades. You would have thought that this was the exact moment that he was waiting for, but there's been a change there, and that's fine. The bench is still deep. Greg and Ajay, these are very, very seasoned folk. It's reasonable to think that a lot of the values that have brought the company to this point will continue to be in place. We wouldn't expect major changes. Wouldn't be holding out for a dividend, or I wouldn't be expecting major swings and aggressive allocations of capital. But there's definitely a culture in place that I think the bench will probably continue to keep in there.
So we walked through the bull case. Let's talk about the bear case, Mel. Let's outline that one. One concern you have, the risk of losing the Buffett premium. Explain that.
Yeah, there's no question. There's no investor out there. There's no CEO or investor spoken about as much, quoted as often. There's so many books out there. I mean, there's an iconic investor. We lost Charlie not that long ago, Charlie Munger. Warren Buffett is stepping down. And so and anyone who's been to the annual event in Omaha will testify that it feels different. It's not a regular company meeting. So is there some premium there? You could argue that some of that's been coming out over the course of the year. It's performed about 2/3 of the overall market performance this year. Some of that is related to some of the underlying business trends, which we can get into in a second. But there's definitely a caution out there that some of the core investors are investors in Buffett rather than in the actual fundamentals of the company itself.
You also say here, Mel, Berkshire's sheer size makes outsized returns extremely difficult. Fair enough. If that's true, Mel, what do you think returns are likely to look like then in the quarters, years ahead?
Well, I think instead of home runs, we're talking about singles and doubles, and I think we should be okay with that. This is a large cap company sitting on a pile of cash, and discipline is really important here. So, whether it's the investment book or it's actually acquiring companies outright, they've always been happy to sit on cash, and that cash pile has grown, and so it's really hard to move the needle. And when you get to this size, like the very dynamics that got them to this point, it's going to be hard to replicate that in the future just because of the size. So I think that the discipline and the continued focus on discipline, again, what do they say? Waiting for that fat pitch. Well, waiting for half decent pitches is okay, but as long as that discipline remains in place, I think more reasonable or more market-like returns going forward, more broad market returns going forward seem reasonable.
You mentioned that cash hoard, Mel. What, as a shareholder, would you like to see them do with that?
Well, I think I think a dividend would be welcome because it would broaden the number of investors who can own it. It would also mean there's an awful lot of funds that would automatically, there'd be a lot of buying automatically into a lot of income funds where there's a rule there that you have to pay a dividend no matter how small. Apple discovered the benefit of that many, many years ago. So some kind of dividend makes sense. I just wouldn't be holding our breath on that one. Ultimately, I think waiting for a better entry point to add to stock, repurchasing shares, that's also very valuable for shareholders. There's tremendous return for shareholders by being patient, disciplined, but then at the right time aggressive in repurchasing stock. So we're comfortable with that approach.
You've laid it out very well, Mel. I'm curious. So who is the investor, Mel, who should be putting new money to work in Berkshire, as you imagine it?
Yeah. So as you mentioned earlier, our clients are shareholders. I'm a shareholder personally. This is for the long-term investor, and particularly investors who find themselves kind of heavily weighted towards the high valuations, the market leadership, anything to do with technology or AI. You're getting a lot of diversification here in this name. Now, we like to think we can diversify for clients with different names, but there's a lot of diversification here. There's a little bit more of a value bent to this name than some of the other large companies in the market. So while near term, you may have some uncertainty here and there, long-term investors have been rewarded up to now, and even if it's a little bit more modest going forward compared to the past, we believe long-term investors will be rewarded for holding this name.
Mel, you broke it all down very clearly and simply. Thank you, sir.
Thank you.
Stick around. Much more Asking for a Trend still to come. U.S. stocks rebound as investors digest easing inflation pressures from the latest reading on consumer prices data. Yahoo Finance's Jared Blikre joining me now with the trading takeaways. Jared.
Thank you, Josh. I don't know if it's CPI related, but chips definitely came back today. They were caught in a 4 or 5 day slump, and the chip dip has been bought. Now, does it continue? Because there's still some territory to make up here that was lost. First, here's what happened today. We can see broadly green here. Here's Micron up 10%. And we were just kind of talking before this segment began that this was a company that people were worried about the guidance. Well, they just knocked it out of the park again, up 195% year to date. So basically the stock price has tripled this year, and you can see it really came alive only in the last few months. Also had some other big outperformance today, but what I want to show you is over the last 5 days, we're still looking at some pretty big losses here. Here's Broadcom that takes into account last Friday's big drop after its earnings disappointed. And so stocks, we look at the Philly Chip Index, and let's see if I can find that. That's down 7.4% over the 5 days. Here's a year to date, and this isn't looking too bad. This is just a big consolidation for now. People might say, well, that's an M top. It's not an M top until you come down here and you start trading under that line. So way too early to call that. For now, this is just a consolidation. But, it's been kind of a strange week, not entirely unexpected because we've had all this holiday trading and it seems like one day to the next, there's not kind of a rhyme or reason that carries through, just a bunch of random things that money is thrown at. Nevertheless, there is, if we take a look at the sector action this week, we do see some standouts. Consumer discretionary, that's just been a Tesla story. Tesla finally breaking to new highs, et cetera. I'm getting off the main point. Chip trade is maybe the start of the tech trade kind of coming back into the forefront.
All right, so we hit chips. What about the broader AI trade?
Yeah, that's, the Mag 7, all of them were up today. And the big question there is who's using AI? We were just talking about Salesforce as one of the Dow laggards this year. And by the way, I'm going to put up the NASDAQ 100 here so we can see. This was the mega cap action today. Tesla up another 3.5%. I don't think it eked out a record high. But who's using AI? That's been Salesforce's big problem, trying to communicate to investors. But I did get the chance to sit down with Mary Esposito. She is a young influencer. This is the second time she's been on Stocks in Translation. She's built several businesses up since the time she was 14, still in college. And here's what she had to say about how she's using AI in her social media accounts.
I do use AI integrated into my workflow. So for example, I use an AI workflow on repurpose.io to automatically post from Instagram to YouTube. So I don't touch my YouTube platform at all, but in the past year, that workflow has enabled me to grow from 0 to over 21,000 subscribers and get monetized under the YouTube Shorts program.
So she's making money on YouTube, and all she's doing is pressing a button, and it's taking the Instagram content and shipping it over. So people are using AI. So that's not to worry. It's just how do we figure out how to monetize that at certain companies.
You want to talk some gold?
Yeah, let's talk some gold here. I do have a clever header for that. We are nearing a breakout point. So gold is coiling, and the long-term trend is up, and I'm going to show you what it looks like on the chart. Now, we've already seen palladium and platinum really explode to the upside, and gold has just been coiling here. So let's see if we can find GC equals F, and that is magic. Oh, thank you.
Look at that.
All right, let's do the year-to-date, and here we go. So here is the record high all the way back here a couple months ago, and it's just been kind of flagging here. That is a very bullish technical formation. When it finally breaks to the upside here, I would expect continuation, because look what happened after it based for all these months. You got that breakout and it just exploded. Now, this is a lesser period of time, so it might not explode as much, but I do think it wouldn't be out of the question to see 5,000 by the end of January. Maybe I'm getting a little ahead of myself, but that's realistic.
All right, that's gold.
Yes.
What about digital gold?
Let's do Bitcoin, because I was watching Bitcoin this morning off the CPI report, and it got a little jolt to the upside around 8:30 a.m. But then guess what? It just fell off. And so it hasn't been correlated to equities recently. Stocks have been kind of finding their footing and going higher since we had that November slump. Bitcoin just can't really find its footing here. So bring it back to the year to date, still working, still waiting for that 75,000 target.
All right, thank you, buddy.
Thank you.
Appreciate it. Stick around, much more Ask for a Trend still to come. Salesforce is one of the worst performing stocks in the Dow Jones Industrial Average this year. Shares are down more than 22% in 2025 as the company faced concerns about AI's threat to software, pressure from activist investors to upward value, and as its AI monetization lags. Market Catalyst host Julie Hyman spoke to a Guggenheim analyst to take a closer look at Salesforce as part of our Down Bad series.
Most people think what they have to do is monetize AI. I don't necessarily think they're ever going to be able to do that. They have to embrace AI, and it's got to be part of what they do. Every traditional SaaS application vendor has to do that to make their products better, like they do every year. But they're probably not going to be able to monetize it because everyone's going to have it. So what I think they have to do is they have to do a better job of selling to the enterprise, and with good AI. Now they came out with Agentforce, as you know, a little more than a year ago, and it really hasn't done well because they had more marketing than they had product, and now they're trying to catch up on the product. But even if they do, I don't think they're going to be able to monetize it.
And what do you think broadly? I mean, this applies to Salesforce, as you say, but it applies to the whole software complex. I mean, are companies not going to turn to those sort of purpose-built solutions that these software providers are trying to give them? I mean, are they going to go straight to the LLMs, which are going to be giving them those solutions?
Yeah, there's this idea out there that everything comes full circle to everything being custom applications again, instead of packaged applications. I don't necessarily think that's in the cards, at least not anytime soon. AI is just not ready for that. And we'll see, maybe in 3 to 5 years that happens or it starts to happen. But I still think there's going to be a lot of companies that want a packaged application that builds upon best practices across the history of those companies, those packaged apps companies. So I still think there's room for these traditional application vendors. But if what you say even happens partially, it does have an effect on their relevance, right? They're very relevant today, or they have been up until recently. There's a lot of questions, but it will have an impact on the relevance going forward.
And John, the company made a big acquisition in the form of Informatica. What has that done for them? Because I know you pointed out in a recent note that there's just not the clarity that you would want around the financial contribution from Informatica.
Yeah, so what Informatica does, we don't think it does a whole lot for them, okay? It's not like Informatica did have a modern platform, but they also had a legacy business, an ETL business, which was the primary business of theirs, being able to integrate different kinds of data but it's mostly for structured data. If you really want, and they claimed Informatica was going to be this big AI play, you really have to integrate all kinds of data. Not that Informatica can't do it, it's just that is not what they primarily do.
Sorry, and John, just explain to me and to the viewers, what do you mean by structured data?
So structured data is the kind of data that most enterprise applications use today. It's data that can be used in a relational database. It's about 10% of the data out there. It is the data that for all applications used up until recently, because managing unstructured data like video files or pictures or things like that was just really difficult. The cost of doing that was greater than the value you got out of it. That's changed. Technology advances have changed that. Informatica has changed too, and they can manage unstructured data, but that's not primarily what they do. What I think Informatica does for Salesforce is they just buy some growth. I don't think it actually provides a ton of strategic value for them.
And so, okay, put all this together. What are the chances that Salesforce rebounds next year?
There's always a chance, and if you listen to them, they're very, very good at messaging or promotion. I don't think it's a great chance. I think there's just as much a chance as Salesforce's relevance continuing to moderate and their growth going from, low double digits, which is what it's been not too long ago, to high single digits, to mid single digits over time. And unfortunately, I think that's just as likely to happen as them rebounding.
So, John, I want to leave by talking about what you do think is going to do well next year, what your pick is for next year. And I got to say, this one surprised me, John. I'm talking about Oracle. You think Oracle is going to bring it back next year. As you know, there are a lot of doubts in the market about this one. What do you think people are getting wrong?
Listen, there's a lot of doubts in the market, and they have to do with debt investors too. So and by the way, I've covered equities my career, so this is a little bit new to me too. And I understand the customer concentration with OpenAI, and there's some questions around that and how they're going to pay Oracle over time. That's real. But the reason we're so positive on Oracle is because they just have a better mousetrap. Their cloud infrastructure is better than anybody else's out there. They provide a service with better performance at a lower cost, and they're still comfortably profitable. So if something happens along the way to some of their customers, which they don't anticipate, and I don't necessarily anticipate, I actually believe AI will progress and will be perhaps the most important advancement in technology in my lifetime. So I think that that'll be fine. But even if it doesn't, even if a customer of theirs sort of has issues, there's enough demand out there, and Oracle's going to be the first choice for AI infrastructure, or any infrastructure it should be. We'll see.
That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wealth.